Hello and welcome to this session. This is Professor Farhat. In this session, we're going to be looking at examples that deal with traditional and Roth IRA. This topic is covered in income tax course, CPA exam regulation, as well as the enrolled agent exam. Now, every time you hear me saying the word examples, it means in the prior session, I did cover the lecture. Therefore, if you need explanation, please go to the prior session, which should be in this same playlist. Now, before I start, I always like to remind my viewers, which is you, to connect with me on a personal as well as a professional level. If you have a LinkedIn account, please connect with me. If you don't have a LinkedIn account, you should create a LinkedIn account. It's good for your professional image. You connect with other people and stay up to date about your industry. If you're a Facebook user, please like my Facebook page and you can connect with me on a personal level. YouTube is where I house all my lectures. You want to make sure you are subscribed to my YouTube. If you like the channel, please like the videos, share them, put them in playlist. I do have a Twitter account, and this is my Twitter handle. And on my website, I do house my courses organized by course and chapter. This recording is brought to you by Jaeger CPA Review. If you like this recording, you would like Jaeger CPA Review. They have a lot of video lectures like mine, thousands of multiple choice questions with detailed solution, simulation, textbook for the CPA exam, audio lectures, electronic flashcards, plus others. If you happen to visit Jaeger, use the code PMF. You will get 10% off of the best valued course. You will benefit yourself and benefit this channel. So let's go ahead and take a look at this exercise to see how much can we contribute to a traditional IRA. Okay, Juan, age 41, earned a salary of 28 and is not an active participant in any other qualified plan. His wife Agnes has no earned income. What's the maximum total deduction contribution to their IRA? Juan wants to contribute as much as possible. How much can they contribute? Well, they're not participating in a qualified plan. What does that mean? It means they're good to go because their income also is low. So Juan can contribute $5,500 for himself, and his spouse can contribute $5,500. You might be saying, hold on a second, his spouse is not working. Well, guess what? Your income will be counted. Since he earned more than $11,000, then Juan can contribute $5,500 for himself and $5,500 for his spouse. Okay, let's look at B. Abby, age 29, has earned income of $25,000, and her husband Sam has earned income of $26,000. They are not active participant in any other qualified plan. What's the maximum contribution to their IRA? Now, obviously, Abby has enough earned income, $5,500. Sam has only $2,600 of earned income. So that's, generally speaking, that's the maximum amount you can contribute. However, since the earning of the spouse, which is Abby, is more than $11,000 from the provisional spouse, Sam could also contribute $5,500 because Abby basically has enough income to cover for him. So total of $11,000. Again, because of the provisional spousal income. Otherwise, you are limited to your earned income. Leo's employer makes a contribution of $3,500 to Leo's simplified employee pension plan, which we'll talk about this later. In other words, Leo is Leo's employer. They have a qualified plan. If Leo is single, has earned income of 32, and has AGI of 29, what amount, if any, can he contribute to an IRA? Okay, now remember, well, you are, so although they are qualified participant, but their income, notice, is single. The phase out begin at 63, ends at 73, so they're way below the phase out range. Therefore, Leo can contribute $5,500 to their IRA. Let's take a look at this example. Jimmy establishes a Roth IRA at age 47 and contributed a total of $89,600 over 18 years. The account is now worth $112,000. How much of these funds Jimmy can withdraw tax-free? Remember, this is a Roth IRA, and they're asking us for the withdrawal. Assuming Jimmy waited 5 years, which we're going to have to make this assumption, and assuming those Roth IRA are qualified Roth IRA, therefore the full amount is tax-free, because when you take the money from a Roth IRA, assuming you meet the qualification, age 59 and a half, therefore all of it is tax-free. the original amount of $89,600 plus the earnings, which is the difference between $112,000 and $89,600. It's all tax-free. Carrie and Dan, age 34 and 32 respectively, have been married for 11 years, and both are active participants in their employer qualified retirement plan. Their total adjusted gross income is $192,000, and they earn salaries of $87,000 and $95,000 respectively. What amount may Carrie and Dan contribute to regular IRA? So how much they can contribute to a regular IRA? Now, I'm just going to tell you. Look at A and look at B. A, how much they can contribute. B, okay, how much they can deduct. Okay, how much they can contribute to an IRA? They can contribute, each can contribute $5,500. You might be saying, hold on a second. Didn't you say the phase out, married, filing jointly, they're above the phase out? Yes, they're above the phase out. They can contribute non-deductible to up to $5,500, non-deductible. Now, how much can they deduct? Notice in B it says how much can you deduct. Now we have to look at the phase out range. Okay. Now, remember that it starts at 101, ends at 121. Hold on a second. They're in the 192. What can they deduct? And the answer is they cannot deduct anything. They can contribute each $5,500. But they cannot deduct it. What does that mean? It means the money that's going to grow later. So this $11,000, well, we cannot combine it because each one has their own individual account. So this $5,500 for each one of them will grow eventually. And when they take it out, the original amount, the $5,500, will be tax free. Now, if it grows to $10,000, the $4,500 is taxable only, the earnings. Okay, so they can contribute it. And the amount is, the original amount is tax-free, the earning is taxable. How much they can contribute now to a Roth IRA? Well, for the Roth IRA, there's a limitation also. You cannot contribute for Roth IRA forever. So how much they can contribute? Let me erase this. Well, there's a formula, and the formula start at 189. So the Roth IRA for married filing jointly start at 189. So let's see. So it starts at 189, and for married filing jointly, so 192. So they are 3,000 above the threshold. Now we're going to take the 3,000 divided by the range for married filing jointly is 10,000 for Roth IRA, multiplied by the maximum amount they can contribute. That's 30% of 5,500. That's 1,650. That's the amount they're going to have to basically exclude. Okay, they cannot include this. So how much they can contribute to their IRA? How much they can contribute? Potentially they can do 5,500 minus the amount they would exclude. They will end up contributing 3,850 to their Roth IRA. So this is how much they can contribute to the Roth. Now, D, how much they can deduct from Part C. How much can they deduct of that 3,850? Hopefully you know. They can deduct none. None of this amount is deductible. Why? Because the Roth IRA, the contribution is not tax deductible. The contribution is not tax deductible. But as long as you wait for 5 years and you wait until you're 59 and a half and you take it out, then everything is tax free. If you have any questions, any comments, by all means, email me. If you're studying for your CPA exam, study hard. If you happen to go to my website for additional lectures, please consider donating.